Oh, risk premium was the last point we were mentioning in the previous part, and basically, if a country is more risky and those that risk might exist due to political or economic factors, each might play a part. Basically, the investors who want to invest their money in those countries may just demand a higher interest rate compared with the interest rate they would demand from countries with lower risks. So as a result, actually, this word interest rate, or the interest rate the country needs set to be able to work with the rest of the world, get funding from the rest of the world, which is different from the national equilibrium interest rate, might be higher for some countries and lower for other countries. And note that the fact that the interest rate in the country is determined by foreign power, the international financial markets, basically, means that the country's ability when its financial markets are fully open to the global inflows and outflows. In that case, the country is not anymore able to freely set its interest rate. The interest rate in the country will be affected from the global factors. If you artificially want to keep the interest rate down, in that case, for example, at this point, well, it would mean that from the perception of the global financial capital, your country won't be anymore a country worth investing in. I mean, some people might have already invested their money there, and some people might still calculate the risk premium differently. But if on average, when risk premium is added, the word interest rate is here, again, considering also taking into account also risk premium of your country. In that case, that country will start losing funds. And to some extent, the reserves of the state might replace those funds up to some degree. But in the end, if the situation won't be improve in short run, maybe as a result of decrease in the risk premium of the country, basically the state's operation to sustain this situation will be it cannot continue forever, basically. At some point, the reserves of the state will end. So this is one thing. Of course, what actually moves this risk premium is a big discussion. But note that when a country is not anymore able to move its interest rate according to its will, also means that it cannot use any more interest rate to basically to execute monetary policy by decreasing interest rate and stimulating the investment level. That's why I mean this interest rate can be a big discussion in some countries, in developing countries especially. An interesting case on this interest rate has actually happened in the US financial markets. In 2008, in the United States, basically, no, of course, I haven't mentioned that here, experienced a big financial crisis. And at that financial crisis, of course, US economy was the one that was experienced at first, but in a short time it spread the whole world. So even though US was center of the financial crisis, the money in the world was flowing to the United States. Obviously, financial crisis has increased the risk in the United States, but when US has a financial crisis, the owners of the financial capital have decided that that crisis is likely to spread the whole world, and even though the risk premium of Turkey will rise up, risk premium of the other countries will rise up even more. As a result, well, US will become even more safer compared with the rest of the world as a result of financial crisis that has started in the United States, interestingly. Because that financial crisis has increased the difference between the risks of those countries, the US and other countries, basically. So that means US is actually a country that is considered in most cases safest country in the world, even at the brink of financial crisis started by the United States itself. So currently in the United States, one of the hottest discussion is the trade deficit, the deficit between the exports and imports, which also affect the current account of the United States and create a large current account deficit. And one thing that actually has created this deficit is the fact that the United States can easily borrow from the rest of the world for a very low interest rate. Well, maybe its financial markets are built in a better way. I mean, it's more efficient. Basically, they are easily here to access for the people who want to lend their money. But also because this perception that risk premium in the United States is lower. And basically, as long as the rest of the world is actually willing to cover this deficit part of the current account of the United States, basically, the United States can sustain its trade deficit. Of course, it also needs to pay some interest rate, basically, and its ability to pay the interest rate is also important in making this case sustainable. So the last topic we will look at will be the exchange rate, which is actually, the value of a currency with respect to another currency. Note that, as I have told before, the money of a country is like an asset of a country. So, for example, if we buy a good from Iran and Iran pays us the money of the good we have bought in Iranian money, we have the money, the Iranian money, which we can use in Iran to buy their goods. So it is, as I said, considered as an asset of the country. And when dollar become global currency, US has distributed its all assets to the rest of the world. So exchange rate we have said, and if one yuan is exchanged for $0.1644, you can buy $0.644 with 1 yuan. Appreciation and depreciation. Appreciation makes a currency more valuable. So if yuan appreciate, then exchange rate will be higher than $0.1644 per yuan, which means, you will need, you will be able to buy more dollar with yuan. Yuan becomes more valuable. If yuan depreciates, it's the other way around. The amount of dollar 1 yuan can buy will decrease, basically. So when the currency of a country can be traded freely by the people who want that currency and by the people who want to sell that currency, for that currency also a market is being created. Well, in China, we can say there's a market. Still, people are exchanging yuan with other currencies, but that market is not free. As I have mentioned before, for example, when I earned money in China, I needed to find a Chinese person and get a special permission to to sell those yuans and buy euro with it, basically, which means the market was not free. I could not do the exchange process freely. So, assuming the market is free, or even if it is restricted, we will have suppliers of the currency and demanders or buyers of the currency. So the market will be just like this. Of course, you can, if this is dollar, for example, pound-dollar market, you can turn this and make dollar-pound market, and basically the people who are buyers at one place will become sellers in the other place. So, how can we measure the exchange rate? The most common way is looking to the dollar value, how much dollar your currency can buy, or how much dollar is needed to buy one unit of your currency, basically. Or the other way around, how much of your currency is needed to buy one unit of dollar, basically. So that's one way of looking it. Of course, euro can also be used, since it also becomes a very not as much as dollar, but still a currency that is used for exchange in the global markets, especially if you are close to European Union. It's an important currency. In some cases, also an artificial basket of important currencies like dollar, yuan, peso, euro might be brought together, and basically value of the money might be measured by looking how much of your currency is needed to buy that basket of currencies, basically. So, how can you basically, what kind of exchange rate regimes you can have? One option is fixed exchange rate, the other one is floating exchange rate. In one case, you are trying to keep your exchange rate stable. In other case, you allow it to go up and down as demand and supply changes. So the idea that floating exchange rate is better is basically comes from the idea that if government doesn't intervene, the market will function better. So the value of the money won't be artificially low or high. I mean, in a way, if exports are too high, for example, or if imports are too high, the exchange rate might change so that the trade imbalances might come to end. If your money becomes more valuable, in that case, you will import more, export less. The other way around, if your money becomes less valuable, you will export more, import less. But that kind of a stability, that kind of a balance might be, useful because, if those imbalances are too high, one country might get too much indebted to other country, and in that case, the country which is actually seemingly gaining might also lose if the other country is not able to pay its debts, basically. But floating interest rate floating exchange rate might actually also create some uncertainties. Main uncertainty is the fact that the value of the currency is unknown, and for investors this creates risks. For example, if someone spends $100 for an enterprise in the Mexico, he will get his money he gets in return pesos when the factory says something. It's protected to the Mexicans. So with $1,000, he's spending 8,000. Let's say 4,000 pesos, and let's say the guy is hoping to get 8,000 pesos. But if the value of pesos depreciates, basically, this 8,000 pesos might be just equal to $1, and the guy might end up with getting nothing. So, if the exchange rate goes too much up and down, for this guy, calculating or making an expectation on its returns in dollar will become more difficult, basically.